Let's begin. So today I'm going to talk about understanding the VIX and the VIX ETPs. So we're going to talk about what is the VIX, its intent, what makes the VIX unique, how the VIX Futures trade, how the ETNs work, and a hedge that I like, and then I'll take some questions. All right, so before I begin, let me talk a little bit more about myself, my favorite subject. I was a floor trader for about a decade. After that, I started Option Pit. Option Pit is an education and consulting company. We work with retail traders, trying to teach them how professionals approach trading. And we work with money managers, hedge funds, asset management groups, all sorts of different types of investment managers. And we'll help them optimize. And we'll help them optimize their option trading techniques. We'll help them implement techniques. And we'll do some risk analysis and stress testing as well. So I like to joke that I've worked with traders with as little as $1,500 and traders with as much as $15 billion. The scary part is most of the time the guy with $1,500 or $15,000 knows more about options than the guy with $15 billion. It's kind of shocking, but that's the way it is. So now let's talk about the VIX. All right, the VIX is the CBOE Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500. So another way of looking at it is it gauges the cost of insurance. And the idea is that when there's more buying over selling, generally the market is trying to buy protection. And when there is more selling than buying, the market is out not seeking protection. So if you look at today, and really the last couple of days, the market has been selling protection pretty aggressively the last few days. So think about it this way. When VIX is up, the cost of insurance is higher, and when VIX is down, the cost of insuring a portfolio is lower. So we are currently at the lowest level of insurance for a portfolio in, over a month. It's been kind of a crazy couple of weeks. So similar to the S&P 500, this index is not actually traded. A lot of people think you can trade the S&P. You can't. You can trade ETFs that try to mimic the S&P 500. You can trade the futures that settle into the cash value of the S&P 500. You can trade a basket of stocks, but there is no way to actually go out and say, I want to buy the SPX. I want to buy the S&P 500. Now, what makes it even more interesting relative to the S&P 500 is there is legitimately no way to trade a basket of stocks or a ETF VIX. Even the futures don't exactly track the cash VIX. So it is an estimate of implied volatility on options as a constant duration of 30 days. A constant duration of 30 days. So what this means is that the VIX always has 30 days to expire. So it is rolling between different contracts to create its cash value. All right. So there is no way. Think about this. Imagine if the S&P changed 1/7 of its index makeup every day. So there would be no way to recreate a basket like that if, without just absolutely getting run over by commission costs. That's why there's no true way to trade the VIX. Right? The closest thing to the VIX itself is a product that's traded over the counter, and it's called a variance swap. Variance swaps trade in typically multiples of $1 million of Vega. So that would be 1 million times the cash value of VIX, or think about it as the cash value of 100 VIX futures. All right, that is the size they trade in. And this is kind of interesting. the weighting of the VIX puts more emphasis on at-the-money options than those trading, those that are trading near the underlying, than it does out-of-the-money options. And that's a piece that can kind of throw people off sometimes. And it's one of the reasons why the VIX has that correlation, where it's negatively correlated with the underlying. So the weighting of the VIX naturally puts more emphasis on out-of-the-money puts than out-of-the-money calls. Out-of-the-money puts that are 100 points away from the S&P 500 are going to be weighted more in the VIX than calls that are 100 points out of the money. It's kind of surprising that that's the way it works out, but that is the way it's structured. The VIX uses two weekly options closest to 30 days to expiration. One is equal to or less than 30 days. The other is more than 30 days. So if we're going to look at this one that I pulled up, you could see that it would be using the one with 30 days and 37. So if I was going to pull up now, should have waited. Would have gotten a better fill. If we're going to look at the SPX and figure out what contracts it's actually using, well, we're here on the 6th. November 6th is going to be 31 days to expiration, and the 30th is going to be 24 days to expiration. So this is the last day. It's using October 30th and the November 6th contract. So these are the contracts that make up VIX. And then starting tomorrow, it will use these two contracts. All right, right now it is 1/7 the 30th and 6/7 the 6th. Tomorrow it will be 7/7 of the November 6th contract and none of the 13th, but it will roll into it as the day progresses. All right, that is how the VIX is calculated. Any questions on kind of the calculation and how it moves? All right. All right. So this is the part that a lot of people don't realize. So the VIX is quoted as a price, but it's really a percentage. So if we were going to look today, the VIX closed around 19, I believe. All right, let me double check. It's probably still closing. I mean, it's still trading, and S&P options are still trading. So the VIX is around 1944 right now. So that 1944 is actually 19.44%. So volatility, despite not being spoken as a percentage, is always a percentage. All right? So a VIX of 14 is actually 14% volatility. Now, this is one of the silly things that the news organizations do. They'll go out and say, oh, the VIX is up 10% today. The VIX is up 15%. It means nothing. That is gobbledygook garbage. How much the VIX is up does not matter. All right? Think about baseball. All right? The Cubs are in the playoffs. They're my team. And they're playing the Pittsburgh Pirates, the Bucks, in Pittsburgh tomorrow. All right? Anthony Rizzo has a batting average of 280. All right? Great batting average. Now, if his batting average went from 280 to 308, that would be him gaining 28 points. Have you ever heard a baseball announcer, a statistician, Nate Silver, anybody say that a player's batting average is up 10%? Absolutely not. Never happened. It's quite possibly the silliest thing that you'll ever hear. All right, so just understand that what really matters is not how much it's up in percentage terms, but how much it's actually moved in points. That's really what matters, because VIX is measuring percentage movement of the S&P. All right, so it means a lot when the VIX goes from 16 to 19. It means very little if the VIX is up 20%. So the VIX is extremely negatively correlated to the S&P 500. And here's a view of the VIX relative to the S&P. The red line is the returns on the S&P 500 on a 2-year period. All right, and you can see that it's very negatively correlated, right? When the S&P is getting off, being sold off, that's when the VIX has its big returns. You see how negatively correlated it is? And here's another view. This is from 2014. And on the left is the S&P 500 and where it is in terms of points. On the right is the VIX. And then here are the dates on the lower end. All right, you see right there, there's the dates. And what do you notice here? Right? When the VIX is up big, the S&P is down. And they're very negatively correlated. All right, but I also want you to notice something else. The bottom of the S&P is here, and the peak of the VIX is really here, which is behind it. Right? It's kind of with this one. And so one thing to understand is that the bottom of the S&P does not necessarily have to coincide with the bottom of the VIX, in fact, or the top in the VIX. In fact, it almost never does. Most of the time, the bottom of the VIX is pretty much correlated with, the top of the VIX is correlated with the peak in panic, not the bottom in the S&P. And we saw kind of a similar thing with this latest cycle. Take a look. So let's just look at 3 months. All right, so this red line represents volatility. And this is that really ugly flash crash day. And here's actually the low close. And notice, not exactly the same. Now, you'll also notice we basically tested the bottom here on the 29th. But what got nowhere near its peaks? I mean, take a look here. This is pretty spectacular. So this is kind of the peak. This is the most recent bottom, and about the same as the bottom here. What does that tell you? Volatility is starting to wind down, wind out of the market. So as you can see, the VIX negatively correlates with the SPX. When SPX is up, VIX is down. When SPX is down, VIX is generally up. This makes sense as generally when the market sells off, volatility does increase. There's also the nature of similar movement against lower numbers. All right, so think about it this way. If we move 20 points when the S&P is 2,000, that is a 1% move. If we move 20 points when the S&P is 1,500, that's a 1 1/3% move. So even though you're moving the same amount, there's a higher amount of volatility. All right. In addition, there's one other important thing to recognize, and that's volatility skew. We've all heard of the SIBO skew index. All right. So the volatility skew index basically is the measure of puts to calls. And as it happens, puts in the SPX are almost always more expensive than calls in disgusting fashion. So when the S&P moves down this line, recalling that at the money options weigh the most against VIX, if we move from here to here, well, even if we just move down the curve, the VIX is going to be higher. So one of the things that I've learned to do is to just measure how VIX is moving against how the SPX is moving. And that can be one way that I'll use to actually call bottoms and tops. So now, what makes VIX unique relative to trading futures or stock? What makes VIX trading so unique and options trading? So if I asked you what the average price of the S&P 500 was going to be over the next 10 years, do you think, who here is going to answer that? What's going to be the average S&P price over the next 10 years? Exactly. Nobody knows. All right, now what is going to be the average VIX price over the next 10 years? That I can answer. All right, so for the S&P over the next 10 years, we don't know what the average is going to be. All right, for the VIX, the average or mean is going to be 20. All right, now that's not, true traders will tell you the average VIX, the real average of the VIX is around 17, but the long-term mean is 20. All right, and the answer is volatility mean reverts. All right, this means that over time it hovers around an average. For the S&P 500, for the VIX, the mean implied volatility is 20. The median mode and kind of where most occurrences take place is around 17.5. All right, that's the way most traders kind of use 17.5 as the true line in the sand long term of where high and low vol are. All right, so this presents trading opportunities. All right, so if one is so inclined to trade VIX and VIX futures, when VIX is above 17.5, it will eventually fall back to that 17.5 level. So there are traders that will trade around that using the futures or VIX options. All right, and when VIX is below 17.5, it will eventually rally back. And, having that knowledge is a really powerful weapon for us. All right, so now, do we have any questions about VIX? Any questions at all? All right. So, the VIX futures represent 1,000 times the value of VIX at expiration. All right, they trade on the SIBO futures trade, and they expire monthly on the Wednesday that is 30 days prior to the next month's settlement. They just listed VIX weekly futures, but they aren't trading very much. They start trading weekly VIX options tomorrow. That could be interesting for VIX. All right. that could make the VIX futures start to move. VIX futures are European, which means they don't, there's no early exercise. So there's no early exercise like there is in the S&P. All right. And they expire into cash based on a special opening rotation that happens on that Wednesday. So this month, the VIX expiration is the Wednesday after normal expiration Friday. Next month, it's going to be the expiration the Wednesday before expiration Friday. And generally speaking, 8 months a year, VIX will expire the Wednesday before expiration, and on Wednesday, and then 4 months a year, it'll expire the Wednesday after. Kind of silly, but you have to know when the futures is expiring if you're going to trade it. All right, so now let's talk about contango. All right, and that is a market condition where back month futures are more expensive than front month futures. When VIX futures are in contango, it represents that the market is more afraid of the long-term market risk than the immediate. And that is when the VIX index is below the futures price. Long-term expirations are that the VIX is going to rise and or mean revert, and the VIX is in contango about 80% of the time. And that is what a VIX contango curve looks like. Here's the VIX cash, and here's what the curve looks like going out. All right, now backwardation. That is a market condition where front month futures are more expensive than back month futures. It's often related to weird cost of carry stuff and things like oil, but in this, it's because when VIX futures are in backwardation, it represents that the fear of volatility in the near term outweighs fear in the long term. The VIX futures are trading below the cash index. All right, and the market in the near term believes volatility in S&P options is going to fall. This is a real, and this is from like November of 2011. So let's take a look at a couple of recent ones. All right, let's take a quick look. This is a great site if you want to learn about VIX futures. So here we are now, and it's interesting because the cash is below the October future, but the VIX futures themselves are in fact backward right now. So I'll show you what it looked. So this is like October of 2008. Let me show you August of 2011, how things progressed. So here is the VIX on August 17th. This is a normal standard, VIX curve. And then here is the VIX curve on August 24th. You can see how it curved. And this is Monday when we were panicking. And you can see how over time that curve can really move. So let me take you back to how August 20, let's just walk through day by day. So here we are on the Here we are on the 17th. Here's the 19th. Oh, we flattened out the 20th. This is a serious sign, folks. If you are trading and VIX futures that go flat like this, something is really wrong. And it is time, likely, to kill your long positions. Because notice what happens. This is a sign that the market is in panic. When we see VIX futures in this formation, market expectancy is extremely negative. I had a consulting client on this Friday tell me he was long 400 SPX deltas going into the weekend. So that's 400 times the value of the S&P 500. We had a discussion about it, and he ended up going out short 100 SPX deltas. Well, do you think he was happy that he did that on Monday? The answer was yes. All right, so now let's talk about, now that we've just briefly talked about backwardation, let's talk about decay. As time passes, traders using VIX to hedge have to deal with the convergence of VIX futures converging to cash in a contango that has a huge drawdown on a portfolio. In backwardation, this will actually put a tailwind. But remember, 80% of the time, we're in contango. So this means that over time, in a contangoed environment, the VIX future and the VIX cash have to converge. So just think about this, just looking at this. If I pull up VIX, if I go to today, so if the VIX stays at 1940 between now and October expiration, where does the October contract have to trade? Where does it have to settle? And on or about? $19.40. Very simple. So these two need to converge. And that is going to be where you're going to make your money and understanding volatility ETNs. All right, as trading in the VIX futures have become more and more actively traded, there's these volatility ETNs. However, due to term structure of the VIX futures, many of the ETNs have some unintended consequences. So the VXX is the most popular VIX ETN. All right. The VXX tries to replicate a portfolio of VIX futures, long VIX futures, with a constant duration of 30 days. The intent of the fund is to allow traders to get long or short near-dated forward volatility. The fund does this, by constantly rolling out of the front month futures and into the second month future. So now this is why I call this the Sisyphus Effect, not the Sisyphus Effect. So we all know who King Sisyphus was? King Sisyphus was made to endlessly roll a huge boulder up a steep hill. The maddening nature of this punishment was reserved for King Sisyphus due to his hubristic belief that his cleverness surpassed that of Zeus himself. Zeus accordingly displayed his own cleverness by enchanting the boulder into rolling away from King Sisyphus before he reached the top, which ended up consigning Sisyphus to an eternity of useless efforts and unending frustration. Thus, it became to be passed that pointless or interminable activities are sometimes called Sisyphean. And VXX has this Sisyphus effect. So in a contangoed state, the VXX is constantly buying futures, riding them down to cash, only to sell them at the bottom level and buy a new future further out. This creates a major problem for an ETN because it is constantly selling a less expensive future and buying a more expensive future. The ETN has a limited amount of funds when buying VIX futures that are in contango based on the funds being depleted. Thus, would you run a business that bought a product for $16.10 and sold it at $15.50? How do you think that would work out for you over time? Unless you're dealing in solar energy, and it's not going to make you money. Right? This is a losing trade. And thus, this is a long-term chart of VXX through right about the time it blew up in April. I mean, this thing has been blowing itself up. Right now, if I were to pull up a max chart of VXX, everyone's like, "Oh, look at how VXX has moved over the last 3 months." I mean, check this out. I mean, it looks kind of good, like a, wow, look at that thing, it's blown up. All right, now let's look at it in a 6-month chart. It's gone essentially nowhere. It's actually lower than where it started at the beginning of the year. Now, let's look at a 1-year chart. And now it's $10 lower. Now let's look at a 2-year chart. Now it's about $40 lower. Now if I go to a max chart, so VXX initial list point price is about $7,000, and it's now worth 20, and it's continuing to roll itself into oblivion. So it is going to be, it's rolling itself towards zero. So in a low volatility environment, being long VXX puts or short VXX or long XI, you know, some of these other ones can make one a lot of money. Different products, similar result. VXZ, that's midterm, that has options. UVXY is double long, levered and optionable. That thing is crazy and is going towards zero even faster than VXX. TVIX is the double long. It is also levered. It does not have options. XVZ is probably the best of the bunch, but doesn't trade very much, unfortunately. If you look at a chart of XVZ, you know, it's probably done better than all of the other products in recent times in terms of how it's managed itself as a hedge. So now some people say, well, Mark, I don't want to trade options. I don't want to do this. I don't want to do that. And so what you can do is look at the inverse ETNs. And the two ones that you can look at are XIV, which does not have options, and ZIV, which does not have options. ZIV is the inverse of VXZ, and XIV is the inverse of VXX. ZIV is much more, doesn't make you as much money as XIV, but is far more stable. All right, so if you were going to compare those two, here's a 2-year chart of XIV, which looked really good until the last couple of weeks. And this is why you have to be careful. When VIX futures go backward, you get out of this trade. So notice in the 3 months, you know, you get up to about $45. VIX futures flatten up on the 20th. You are out at $44, and you'd be getting back in around 27. You would have saved yourself about $15 of pain. Okay. Meanwhile, the more stable of the two is ZIV. And same thing. Now, it has not had the same type of pain. Got up to about 40, 50 bucks, dropped about 40, but you would have gotten out if you follow the backwardation rule for 48 bucks and gotten out back in around 40. You'd have saved yourself 8 bucks of pain. So basically, these inverses are great. So now let's quickly talk about VIX as a hedge. So if one is using a near-term hedge, the VIX can potentially work better. Basically, VIX has this sticky strike. All right, so think about it. At the beginning of the year, the VIX was about 15. The S&P was about where we are. In the middle of the year, the S&P was about 2120 at its top, and VIX was still only around 13. It didn't lose very much. All right, so VIX has this sticky strike and can do really well if the S&P takes a quick drop. So here's the VIX in 2015. So you had this whole period where it just kind of sat there and quickly made some money. So if you ran a hedging operation, you could do pretty well with VIX, all right, if you know what you're doing. So the major issue of using a VIX as a hedge is that backwardation. So if I buy a VIX $18 call expiring in October, it's highly unlikely that VIX will be able to move far enough out of the money that the strike no longer hedges. All right, so how does that compare to hedging using a sharp move in SPX? So let's look at August. All right, let's look at that sticky strike. So if I buy a VIX $18 call in May expiring in October, the VIX isn't going to run away from it. All right. Meanwhile, the SPX moves from 1950 to 2125. So let's look at how things moved on July 14th. All right. The OX future was around 1682. The S&P was around 2104. So now when we had that August volatility explosion, that October 16 call goes from 250 to 850. So it more than triples itself. And the future goes to about 2269. Makes $6. And the S&P future goes from 43 to about 86. So the S&P doubles, the VIX future more than triples. So if you did that on a dollar cost basis, you make way more. So think about this. So let's divide 43.2 divided by 250.
Hey, Mark, just want to give you a heads up. You're looking at about 3 minutes remaining.
All right, I'll be ready. So what's 17.3 times my $6? I make 103 bucks instead of 43. So VIX can be a great hedge. So now let's talk about the smart hedge. So one, wait till the VIX is below 13, set up your hedge. The alternative is actually wait till the curve flattens up. So when the curve gets flat, buy at-the-money calls in VIX, all right, or VXX, and then sell VXX calls against it when VXX rallies. So one thing you can do is to hedge in VXX when things get flat, and then when they explode, turn it into a call spread you'll own for free. So in summary, VIX is a great product. The VIX ETNs can be awful, and I like using it as a hedge when the market's is bear. So now, here is my special offer. We did a VIX primer that really dug into the volatility ETNs. We spent about 2 hours on the volatility ETNs and 2 hours on trading VIX futures, VIX options, and using VIX to hedge. At the time when we sold it live, it was listed at $247, and we sold it at $147. All right. Now, because this is a recorded thing from September, so from last month, through the end of the week, I'll take an extra $100 off. use code IIVIX when you log in at optionpit.com/VIX Primer. So 47 bucks. I mean, that is the cost of taking the family for lunch at a diner. And this is a 4-hour in-depth look at really trading VIX ETNs, like VXX and UVXY, VIX options, and VIX futures. So if you have interest in learning this stuff, this is the course to take, and you'll be a very happy camper you did.